Well, cross-asset volatility remained subdued last week, with markets largely just meandering and really struggling for direction. The G10FX market respecting, by and large, the recent ranges in which we've traded, and treasuries going nowhere fast either. We also saw subdued trade on Wall Street, but we do continue to see outperformance coming through in European equity markets, where indices continue to rally as we move into earnings season here in Europe. And it's also a huge week ahead for the corporate reporting season in the States as well, with big tech coming into focus. Traders have also got the next BOJ decision to contend with as well. Ueda's first at the helm of the Bank of Japan. And we've got a little bit of a lighter data calendar with just the US and Eurozone GDP prints really highlighting things, but there's plenty of intriguing setups for Ryan Littlestone and I to get into in this week's Trade Off UK. Well, the introduction to the show this week only took 3 takes, so I guess things can only get better from here on in. Let's bring in my co-host, Ryan Littlestone, from Forex Flow Live and Forex Analytics. Ryan, how are you doing this afternoon?
Yeah, all good, Michael. How are you, mate?
I'm very good, thank you, mate. I'm very good. A little bit depressed on Friday night at the Arsenal result. We're doing our best to throw the title away, but thankfully Spurs cheered me up yesterday, letting 5 in 20 minutes. Well, what a fun afternoon that was.
Yeah, I think that cheered everyone up. And we managed another win, so onwards and upwards for us, yeah. And check your car, because I think your wheels might be falling off, mate.
I think the wheels have already fallen off. I think the title is dead and buried at this point, sadly. And unless we can pull some sort of miracle out of the bag against City on Wednesday night, we can kiss goodbye to that one. Speaking of miracles, we might need a miracle to spark some volatility in the markets. So let's get into that in Topical Thunder. Well, it's another week, and it's another decline in volatility across the board. I guess we've all been asking ourselves over the last 2 or 3 trading weeks, are our screens actually turned on? Is the market actually on? Are things moving? Because such has been the real lack of any real major moves over that time period. Things are starting to get a little bit boring. And I guess traders are really just searching for a catalyst at the moment. To put some numbers on the decline in volatility that we're seeing, the VIX, which obviously tracks 30-day implied vol for the S&P 500. That's as near as makes no difference at its lowest level since November of 2021. And perhaps more interestingly than that, when you look at realized volatility, the S&P 500 has now gone just over 3 weeks without a decline of more than 1%, which is the longest run in a couple of years, certainly since the bear market began. We also see this decline in volatility in other asset classes as well. The MOVE index, which is a similar gauge, but for treasuries, that's at its lowest level since late February. Implied volatility across the G10FX space is at or very, very close to the bottom of the 12-month range for pretty much all majors and most of the crosses as well. And even if you start to look into commodities, implied vol on gold, that's at a 6-week low. When you look at the 1-month tenor, volatility in oil's picked up a little bit, but still very, very subdued indeed. And I think there's 2 ways you can look at this, and I'm keen to get your take on this, Ryan. Firstly, you could say, is the market being a little bit complacent? Or you could say, is this really justified? And I would actually take the view that this does seem to be justified. We're in an environment where the banks are quote unquote solved. I don't like to use that word and tempt fate, but it does seem to be the case at the moment. And really, we are lacking those catalysts. The next Fed meeting is not until next Wednesday. And I think until we get there, the market really is lacking catalysts and factors to trade off. And that brings me nicely into my second point, which is what the hell is going to breathe some life into markets? Ideally, you look towards that Fed meeting. That is the next marquee event risk on the calendar on the 3rd of May. And of course, you've got the ECB a day after and the latest jobs numbers out of the States a day after that. So that's going to be a busy week. But also, you've got earnings in the mix. You've got just over 40% of the S&P 500 market cap reporting this week, including all the big tech names, Apple, Alphabet, Amazon, and Meta reporting as the week goes on. So maybe that's going to breathe some life into things. But personally, I think we may be in for, and I hope I'm not tempting fate here, another relatively range-bound week until the Fed, and that might be when market participants start to reassess things a bit.
Yeah, well, I do hope you have given it the kiss of death with that calmness in the markets. But we've been speaking about it last week, and it's what we've been expecting. And I think it is the market pretty settled to where central banks are at the moment and where the fundamentals are. We've seen good bits of data, we've seen bad bits of data. nothing's really pulling in the same direction for the moment, although some of the US data in the latter part of the week, the PMIs on Friday, they came in positive in both sectors, manufacturing and services. So that points to a little upside surprise for the US economy. But you're right, we have some key data which we're going to touch upon, but there's big events as well. We've got the Bank of Japan on Friday, and in between these events, this low vol is perhaps going to keep markets quiet. But that said, when you do get a piece of data, the market's waiting for it. It's going to put its emphasis on those, and we're going to get some decent moves if there's big variations. So there's going to be plenty to trade. We need it to keep trading, but maybe in between those quiet periods, in between headlines, we are going to see things quieting down.
Yeah, I think you're right. I think it's interesting you mentioned the PMIs. Actually, they slipped my mind when I was putting the notes together for the show. Actually, it was, I think, two takeaways from the PMIs, and we'll get onto data a little bit more in a second. I know you want to talk about that. Firstly, the divergence between manufacturing and services continues, and actually is getting wider, particularly if you look at the Eurozone. I think the manufacturing gauge was at its lowest level since June or May of 2020. I can't remember which. But then the services gauge was at a one-year high and expanding at a faster than expected clip. I think it actually beat all of the Bloomberg estimates when you look at the survey that was submitted. So that's an interesting divergence. And I think as long as we see the services sector remain relatively resilient, that's going to embolden the ECB to continue raising rates. We had the Belgian central bank governor out with an FT piece over the weekend saying actually the deposit rate could go north of 4%. We're not going to slow hiking until wage growth begins to slow, which is slightly ironic given that wage growth hasn't actually kept up with inflation, but never mind. And then the other interesting divergence is across the Atlantic, because you see this subdued nature of the manufacturing industry and arguably a manufacturing recession on this side of the Atlantic, but US manufacturing is back and seems to be booming again. And I think that's something that's certainly going to keep the Fed in a little bit more of a hawkish mode for longer as well.
Yeah, I mean, I wouldn't call manufacturing booming over there. It only moved back into expansion relatively. But yeah, a bit of divergence. I mean, the numbers we got last week, Empire manufacturing was pretty good, and then we got a really stinky Philly Fed. So, I'm not sure whether this is just a little bit of a lift up that we're going to see reverse again. But that's been the nature of this data. Up, down, up, down, up, down, no trends. And that's what the market wants to see, because the Fed is going to react, either keep raising or changing policy, whether it's more hawkish or more dovish, depending on how the data comes. But until we get some proper trends, the market's happy to sit in the middle.
Yeah, absolutely. Well, go on then. What data should we be looking for this week?
Yeah, we have got some key data this week. And there's three I've really picked out that potentially going to be more important for the market, for the Fed, for the central banks, for the ECB, for the Bank of Japan. So the first one is tomorrow we get the main US consumer confidence number. The headline is obviously going to be important, but as we saw with the Michigan reading the other week, we had a big jump in the one-year inflation expectations from 3.6 to 4.6%. That's going to be watched closely by the Fed. We get the one-year expectation numbers in the consumer confidence, so we need to keep an eye on those. If there's another big lift in that, likely to see yields rally, likely to see the dollar bolt, likely to see those hawkish expectations growing a bit more for the Fed again. Then on Thursday, US leads the way in the first Q1 GDP data, the preliminary numbers there. And again, we're going to be looking how our economy is coping with rate hikes. Are we going to be seeing recessionary pressures? The data, as we say, has been mixed. US, Europe, sector differentials. So is this going to mean we're going to see some recessionary pressures, or our economy is going to be muddling along, maybe a little bit positive? Again, nothing gangbusters, nothing completely collapsing, but it'll give us a good indication the market's going to move on it again. And also, then on Friday, we get the big BOJ meeting that we've been waiting for weeks and weeks. The new man who either in play, he's come in over the weekend, pretty much sticking to the same script that they're going to need to continue easing. So no one's really expecting any changes from this meeting at all in terms of monetary policy, but it's all going to be about the language. We had seen sticky CPI last week. Just before the data, just before the announcement on Friday, we're going to get Tokyo CPI for April, which makes up around 20-25% of the CPI basket, because obviously Tokyo being a big city. So That's the fresh data for April.
Understatement of the week there from Ryan. Tokyo is a big city.
Well, compared to some of the little cities, yes, it's a big, but I'm talking about in data terms, it's a big number for the whole basket of Japan. So that coming right before the announcement could put a bit of inject a bit of volatility into yen pairs right before that announcement, and then when we get that announcement, like the touch paper.
Yeah, exactly. No, I think you're right. It's going to be an interesting week because you've got those GDP numbers from the US on Thursday. You've obviously got the similar data coming out of the Eurozone on Friday morning as well. They're going to be interesting, I think, from a macro point of view, as you rightly say, where is momentum being lost? Who is at risk of going into a recession quicker than others? But you do tend to see actually the GDP numbers, their impact on the market these days, at least, does seem to be relatively limited because we've got so many of those leading indicators like the PMIs that we were just talking about that almost tell us everything we need to know and allow us to discount a lot of what we find out in the GDP releases before we get the number. And I think that's why those leading indicators are so much more important, and why that consumer confidence number at 3 o'clock on Tuesday afternoon is something that I'm certainly going to be watching very, very closely indeed. I think the year ahead inflation expectations is absolutely the key component, as you rightly say. I tend to focus more on the direction of travel of that component rather than the actual level. Consumers are very, very well known for having an absolutely appalling track record at trying to predict the exact inflation rate. So what you're really looking for is, like we saw in that UMich survey, is there a massive upward shift in expectations from one month to another? Not necessarily is it 3.6, 4.6, 5.6. The number doesn't actually matter. It's which way that is moving. And of course, the Fed want to see those inflation expectations coming down. They want to see that moving closer towards their 2% target, because that implies that inflation is not becoming entrenched in the economy. Of course, if consumers expect inflation to continue moving higher, or even the rate of inflation to accelerate, then their wage demands are going to be much higher. And therefore, you end up with this kind of wage price spiral risk. And of course, that's the absolute worst of all worlds. Just to wrap up on that, of course, the BOJ on Friday, I think that's going to be interesting. I'm not going to be getting up early for it for my sins. I'd rather protect my sleep than watch Ueda give his first press conference. But I do think there was a couple of interesting media reports last week, and obviously take that with a pinch of salt. Firstly, Reuters had a quite a good sources piece saying no changes this week was the long and the short of it. And then in the Nikkei over the weekend, there were a lot of reports that the BOJ are going to be doing effectively a strategy review of the last 2-3 decades of ultra easy policy. And this, to me, kind of says actually they're laying the groundwork to do something in June, because strategy reviews, you can't do them in a week. Arguably doing them in a couple of months is a little bit punchy to expect that. But I do think it just lays the groundwork for the BOJ to say, this is what we've done, this is why we did it, and this is how we're going to get out of it. And I think that gives them a really nice way of framing that decision and that exit from years of ultra loose policy. And I just wonder, looking a little bit further ahead than we tend to in the show, whether you're going to start to see people positioning into long yen positions in kind of mid-June in anticipation of a potential BOJ hawkish pivot, rather than the dovish pivot we always talk about, a hawkish pivot in their meeting that month.
Yeah, absolutely. Some of us are already getting positioned ready for that. I have been for a couple of weeks since I got back from holiday. But it's going to be big. And, I can't not reiterate the stance that it doesn't come down to change in actual policy. It can just be keywords in the statements, keywords changes in the forecast that we're going to get. And that's going to be enough to potentially send the yen on a big wild ride.
Yeah, absolutely. It is those hints, those clues, those very, very subtle changes that if you're not paying attention, if you've not read the statements they've been putting out recently, you won't notice and you will be caught out. And this is why trading policy decisions, particularly when it comes to someone like the BOJ, it's absolutely key to be right on top of what that central bank has been saying in the statements, in the minutes, in the accounts, in recent speeches from policymakers. You need to be all over it, because otherwise you are going to miss things. Speaking of central banks, let's get on to the Bank of England. Oh dear, oh dear, oh dear, oh dear. What on earth is going on Threadneedle Street? We had, as we covered in the show last week, actually in this very segment, a huge week of data out of the UK last week. And let's be honest, it was pretty grim. The inflation numbers were horrible. CPI rising by 10.1% on a year-on-year basis. That's the 7th month running that core CPI has been above 10%. And it's now 9 months since we went above 10% in the first place. Core inflation at 6.2% on an annual basis. So headline inflation is 5 times above the BOE's target. Core inflation 3 times above it. I think in anyone's estimation, that has to just go down as an utter failure from Andrew Bailey and co. down at the Bank of England. When you look at the labour market, things are looking a bit dicey there. We saw unemployment rise to 3.8% in the 3 months to February, and earnings growth remain unchanged from the pace that we saw in the month of January, around 5.9% year on year when you include bonuses in that earnings growth. So increasingly wages chasing after prices. And of course, this is before a lot of the industrial disputes have been settled. I think the train drivers are still at risk of strike, the nurses, the doctors, all the rest of it. Consumer spending is slowing. Retail sales fell by 0.9% on a monthly basis in March. And then those PMI numbers that we mentioned, the manufacturing gauge hitting its lowest level since 2020. And I guess the only real glimmer of hope is the services PMI hitting a 12-month high. But you've got to argue that with the labour market starting to soften and inflation remaining persistently high and retail sales falling, I do wonder to what degree, that the services sector can continue to hold up. Of course, this has led the markets to hawkishly reprice their expectations for BOE policy. The market now pricing another 2 25 basis point hikes from the BOE, one on the 11th of May, and that's certainly my base case, that we go to 4.5% there. And then the market also prices another such hike in June, which would take us to 4.75%, getting worryingly close to Ryan's 5% forecast that I still think is just going to be a little bit punchy, although perhaps not by as comfortable a margin as I was expecting at one point in time. What I would just say before I bring you in, Ryan, is I don't think this is particularly good news for the pound. You've got a BOE that is hiking into a slowing economy. And although we're going to see further rate hikes, that is only going to deepen the slowdown that we're likely to see. And I want to quote here from one of our mutual friends and a friend of Pepperstone and TraderX, Mr. Dickie Matthews, who is a legend in the city. And he put this in his morning note this morning, and it sums it up better than I can. I quote, "The BOE chose to stick its head in the sand. Although it was first to act, it was then slow to take decisive action on inflation. It's now facing the reality of hiking into a recession as they face the worst possible economic scenario, stagflation." My question to you, Ryan, is why would I want to buy the pound in that sort of an environment?
Well, as always, Dickie's being polite there. I would use a different word than sand. Yeah, it's always twofold, and particularly for us in the UK, we look at the pound in terms of what's happening in the UK, the data and everything. Then you've got to look on the pound on the other side, what's happening in markets, what's going on in the other currencies, such as the yen. The pound has remained a bid against the yen. Even against the dollar, we're still hovering around that 124.5 area, up near the 125s. So you've got to look at it and think, well, if you were looking at the economy, you'd probably be a pound seller, and you most probably are. But then you look at the other side, what is everyone else doing? And that's where you get your clues on, because as much as I hate to say it, we don't rule 3/4 of the world anymore. So what happens in other economies, the ECB, the Fed, is going to outweigh what happens over here. But it's going to be two speeds. The Bank of England, I still think, are going to 5%. That doesn't mean I think it's the right thing they need to do, and that it's going to be good for the UK. But monetary policy is monetary policy. They've got to act on inflation. And while inflation is still high, they've got to continue hiking, in my opinion. So they'll get to 5%. It will be the wrong thing to do. If that does crunch the economy, then, yeah, I'm going to be front of the queue for selling the pound on that compared to some of the others. But on the flip side, lots of people are always very bearish on the pound, very bearish on the UK. And often it can confound those thoughts. And we see good data coming out. We see progressive numbers, and suddenly the pound's rallied 500 pips and everyone's asking why. So you can never rule out the UK, tough bulldog spirit and all that.
I agree. It's an interesting one, but we'll see how that plays out. That's for sure. What about some trading ranges? I know you want to talk about volatility again, or the lack of it, so to speak.
Yeah, well, we spoke in detail about volatility last week. How I noticed that the numbers have been dropping and things may be getting quieter. But you've got to know how to trade that really. And we touched on it last week, but I want to touch on it a bit further this week. And low volatility isn't good for us traders in terms of, intraday trading perhaps. But what it does do, it usually cements the wider ranges. So as a trader, if you're a short-term trader, a scalper, if you trade the 15-minute charts, the half-hour charts, you've still got to understand what's going on in the bigger picture. So traders always need to know their surroundings and the whole surroundings. So the idea here is that you have to look at your charts on all time frames. So in the back of your mind, you've got an idea where the big levels are, because some of the bigger ranges, maybe 3, 4, 5, 600 pips either side. But there's times when we're going to move to those. And sometimes if you're trading the short term, you haven't got an idea that maybe one of your short term levels is actually a big long term level. And those are the ones that can bring you some decent pips. I mean, we looked at dollar CAD last week. We're talking about hitting the bottom of a range down at 133. Well, it's bounced 250, 260 pips since it touched that range. It took over a month to go from the top side of that range to the bottom side of that range. So when you're playing these ranges, you do need some patience. We're right in the middle of that dollar CAD range at the moment. We may get a move back to the highs around 137s, or we may go back to 133. But if you have those levels at the back of your mind, if it's quiet, nothing going on, and things are dragging along, but you suddenly get those big ranges tested, that's where you can have some decent trades, because if you've got low volatility, those big ranges are likely to hold, and that's, you get in a trade, you sit in it, you push it as far as it can go.
No, absolutely. And this is very similar to the point that we were both making around knowing the central bank that you're trading. It's around knowing the market that you're trading. You need to be familiar with the levels that have been historically and psychologically important. You just think some of the major FX pairs, 110 in euro dollar, 125 when you look at cable, 130 when you look at dollar yen. These are all huge levels that have been significant in the past. And even if you are trading, as you say, over those shorter time frames, it's really, really important to be aware of how those longer term charts interact with the shorter term price action. And it's all about equipping yourself to be to have the best chance as you can, to be as profitable as you can. Because the more information you have, ultimately, the more aware you are of what's going on, and the more likely you are to be able to place trades in and around these levels and make a profit on the position as well.
Yeah, exactly. And as I say, you could probably ask me any pair, though, because I'll have a blank mind as soon as you do. But
you knew exactly where I was going to go.
Exactly. You could ask me, pretty much any major pair, and I'll know where the wider levels are, because it's just ingrained in the back of my mind just from doing that exercise of looking at the charts, seeing where the monthly, the weekly, the daily moving averages are, fib levels, trend lines, you name it, and they're always in the back of my mind. So I know if I see in the short term, if I watch my 15-minute charts, which I do every single day, that's my price action charts, and suddenly we get to a level and it triggers in my mind, oh, actually, this is a bigger level on the long terms, let me check it out. And then that forms your trading decisions.
Yeah, absolutely. And it's that preparation. We were talking before the show. I know we both sit down on a Sunday and go through the charts, go through the news, go through some research, look at what's going on, look at those levels that are in play. And it's about having that process and that really structured and well-defined process and sticking to it. And it will stand you in better stead when the market then opens and when you look to place trades and open positions.
Yeah, exactly. Best tool for a trader is preparedness.
100%. Well, on that note, let's get in some charts in That's a Setup. It's quite remarkable this week. We've spent the first sort of 20 minutes of the show talking about how there hasn't been any volatility in the FX market, and then we've come up with 4 FX charts for you, which could be interesting for us to get our teeth into. But nonetheless, let's get our teeth into those charts. I want to start off with cable. I mean, cable just kind of is a good epitome, really, of the range-bound trade that we've been seeing. I know I got moaned out for saying this last time, but we have been in a tight-ish range since last November, 4 or 5 months in about a 7 big-figure range. And actually, you can see from that chart, it's started to tighten up even more. And actually, over the last kind of really 3 or 4 weeks, we've been stuck between about 123.80 and just north of 125. What's interesting is this 124.50 to 125 region, because we've again seen sterling's gains fizzle out around this level. We saw this happen towards the tail end of last year, around the start of December. We then saw it happen in mid-January. We had that move lower, and now we had that rally back. And again, we've stalled out around this level. It just feels like at the moment, 125 is a little bit too much of an ask for the bulls to really make a decisive break north of this level. If you look at the chart closely, you'll see we actually only had a closing break north of 125 on one day over the last 6 or 7 months. And I think that just shows how difficult it will be and how significant an impetus it will need to actually force price through this level. Of course, event risk is a little bit lacking this week. I guess we need to put month-end flows on the radar as we move towards the back end of the week. But it does feel like at the moment, and I justified the fundamental case for this earlier on in the previous segment, it does feel like, for me at least, the risk reward here tilts towards being short cable. If the bottom of the recent range at 123.80 gives way, then you can see that there is scope for further downside. The absolutely huge level is around 122. The 50-day, the 100-day moving average, and the big figure, of course, in the mix as well. It doesn't feel like we're going to get there in a hurry, but it doesn't feel like we're going to break north of 125 in particularly much of a hurry either.
No, but you've got to look at one thing. The trend is your friend. At the moment, we continue to make higher highs, and just about we continue to make higher lows. And until that pattern breaks, you're going to keep, you're going to keep the trend. And it does suggest, in my opinion, that maybe the upside is going to be the next move we make. But you're quite right with your levels. It's going to take a move under that 123.80. If you get below there, hold below there, maybe something's changing with the trend. We've broken the pattern and we're going to head a little bit lower. Are we going to collapse all the way to 122? Quite possibly. That's the next level you'll look at. And I think off the top of my head, there's some fibs around there if you mark that move up off the low. And fibs are another good tool to use to gauge how a trend is moving. Move to the 38.2 and bounce from there. The trend remains in play and it's just a bit of a refresh. But start breaking those fib levels, and then the trend is starting to break as well.
Absolutely. The reason I didn't put the Fibonacci levels on this week was because I knew Blake Morrow would steal this chart, and I just thought I'd be kind and let him have a little bit of work to do when he copies this for his own version of the show, rather than just giving him everything on a bit of a silver platter as we usually do. We love you really, Blake. Don't worry. Ryan, what about Euro Sterling?
Yeah, keeping to the pound theme here, and this one's been a bit of a sideways moving crab, if you like, not the technical pattern, the animal. And we've been knocking up against this 88.60 level. It's been a really solid level. But what's striking for me is that we keep coming back here. And I never like a price that keeps coming back to a level fairly quickly. That just suggests that shorts are happy to go in there, but the buyers are also quick to take it back. And this one emphasises really my early view on, looking at ranges and historical levels and how they keep showing up. This 88.60 has been one that's had us saying things, going back for months. And I think this one is perhaps one to watch for a quick break play. A break would take us lightly to 89 pretty quickly. So you can maybe catch some fast pips there. If you buy the break of 60s, look for that run to 89. That's going to be the next area where things are going to get solid. 89.20 is the big level. Otherwise, if it holds, then you can look to play the range from there back down to the 87s, low 87s, and just look to do the, as my colleague calls it, the washing machine program, which is rinse and repeat, and keep trading the same ranges, and in you go, out you go, watch the levels.
Who on earth is calling it that?
K-Man, like K-Man. We have several trading strategies. The slice and dice, the washing machine program. Yeah, we've got them all.
Learned two things there: the crab pattern and washing machine strategies. There we go. Don't ever let anyone say that this show is not educational. I think you're absolutely right. It's really interesting how the market just keeps getting drawn to this kind of 88.60 region. And as you say, it just really tells us that there isn't a lot of impetus to move things too far either way. I think it's quite clear that market participants are happy to bank a few points on one side and then bank a few points on the other and then on the other. And as you say, that until we get something that really shakes the outlook up, maybe we look to the ECB next Thursday, then it doesn't look like this sort of range is going to break anytime soon.
Yeah, absolutely. And just been saying it, ranges, trade the levels until then they're gone.
Exactly that. Well, speaking of the ECB, speaking of the euro, I'll look at euro dollar. Again, a good indicator of how there's not particularly much volatility being seen, and another good indicator of how we had that run lower in the dollar, which then seems to have stalled out a little bit. The dollar index last week, of course, a massive weighting, 60% towards the euro. That had its first weekly gain in 6, and we also saw the euro have its first weekly loss in 6, funnily enough. It's interesting that we got to those 110.75 highs, but couldn't push further higher, and we're now back around the 110 handle, although since I made this chart this morning we have broken above 110 once more. We are in quite a tight range. 110.75 is the upside resistance, and then you've got this brown trend line that's been in place really since, when is that in the chart? Since the start of March. And that's been running that uptrend. And the gap, the region in which we're trading between those two levels is getting tighter and tighter and tighter. I think if we can get north of that 110.75 on a closing basis, then we look to perhaps even take out the 111 handle. And again, if we get below, I think the support comes in around 109.30 on that trend line, then you'd look for a move down towards sort of 108, 107.50, which is where the next support to the downside comes in. So it's another case really of volatility being low, having those ranges marked out, having the view on both sides, and then reacting as and when we get a break of either of those levels. But I think this is just a good epitome for me of, one, the low vol that we see, and two, the bearish dollar trend stalling a little bit, perhaps running out of steam a little bit, and the market just really waiting and seeing for its next direction and which way we're going to move in the near future.
Yeah, and this is very similar to a lot of dollar pairs. It's similar to cable. It's similar to Aussie dollar, where we've had that rally from September, October, got up to that 110. Then we had a real good pullback to the 105 level, which was a big level on the way up. That refreshed the trend. On we go again. Then we make a fresh high. So similar thing to cable. The trend is your friend. We're still making higher highs. Looking at that recent high that you say 110.75s. If we have a test of that, but then we hold it, then maybe there's something for shorts to get into, because we've confirmed that high. Then we've got a level we can trade. That's where we can lean shorts against, see how far it dips if it comes lower. Conversely, if it breaks, that's likely to give you your next leg high. And as you say, if we close above that, maybe that becomes a decent support level. So if you miss the initial break, look for a pullback to there. If it holds, there's your conviction to get in along again and see if it runs back higher.
Exactly that. Have those levels, keep them on the radar and react appropriately. I get the feeling that might be the story in dollar yen as well, given the theme of the show so far.
Yeah, well, we were talking about the Bank of Japan, obviously, and we've got the BOJ coming up. So we've got to expect that there may be some volatility coming into this one. Trading requires always that you have a plan, but there's certain times when you got to let the price do its thing. And this is one of those moments where the BOJ is going to come out. It's either going to be nothing burger or it's going to be something significant. I think it's going to be significant either way. Significant if they stay the course and keep to their old lines of monetary policy. Significant if there's some changes in there. So there's lots of unknown. So in this one, really, trading here in the middle or the levels we're at now, I'm not that keen to get involved. I was happy to do a bit of sniping last week, just a bit of scalping of the levels. But right now, I'm all about managing my core position, knowing where I'm going to put my stops and looking at the wider ranges, as we said. So the ranges here for me are up at 138, down at 127, 128. 1,000 pip range, that's a big range to play there. But this is one of those moments where we could get a significant move. We're closer to the 138s. Any move up there, the market's going to have to ask a question. It's a big solid level. If it can't break through that, the market's going to say, right, we've priced whatever's come from the Bank of Japan. That's a level we're going to hold. It confirms the range. On the downside, we had a big solid level down there at 127. We get a decent move down there. Again, the market may decide that's the stretch point for this move, confirms the range again, and you can hit it off the bottom. So, I'm looking at this one, play it both ways, but let's see what happens over the Bank of Japan.
Yeah, exactly that. It's going to be an absolutely huge event, as you say. I think the way I'm looking at things, just to go into the BOJ in a bit more detail, is look at the balance of probabilities. There's realistically two directions of travel that you either could take at his first meeting. He's either could come out and say explicitly or hint at a continuation of Kuroda's policies, the YCC, the quantitative easing, the negative rates, or he could come out and start to hint at and lean towards and point the markets in the direction of tightening things up, exiting those easy policies over a period of months as we move through to the remainder of this year and the early part of next year. And for me, the balance of risks firmly tilts in favour of the latter. It seems very, very unlikely that he would come out and say, we're going to do exactly what Kuroda did for a number of years. That doesn't seem a particularly high probability to me. So when you couple that with the fact that Treasury yields as well look to be reaching a little bit of a ceiling, particularly at the front end, as we expect the Fed to go on pause from May onwards, I think the risk reward favours a move to the downside. But as you say, you've got good levels on both sides if you do want to play that.
I just want to add as well that we've got to remember that the big market moves on central banks don't happen on actual policy changes. It happens on the market's expectation for those changes. So it can only be one keyword that changes in the Bank of Japan statement, and the market expectations will run with it. That's what caused most of the dollar-yen move all the way up that we saw last year.
No, absolutely. Well, with that said and done, let's get on to our plays of the day.
So, non-FX, look at that.
I know. Well, one of us has got to go non-FX. That's I'll take one for the team this week. You can do it next week. I want to look at the S&P 500. This is the future, but you can do the same thing via the index or via a CFD or whatever you want to do it. However you can get exposure to the S&P 500, you'll be able to come up with a similar chart, a similar idea. The old saying goes, never short a dull market. It seems to be my boss, Mr. Chris Weston's least favourite saying in the world, given what he was saying last week. But personally, I think there's a lot of truth in it. If you think about institutional cash and the way that gets allocated to the market, as volatility declines, the risk premium associated with equities declines, and that brings institutional buyers and asset managers and pension funds and all the rest of it into the equity market. They can increase their exposure to stocks. That buying, given that rallies tend to have an inverse correlation with volatility, takes volatility further lower. That brings us more buying. And you end up with this kind of self-fulfilling virtuous cycle going on. So all the time that volatility is low, and the VIX is 16, 17 roughly at the time of us recording this, all the time vol is low and declining, it makes being short equities quite difficult to justify in my mind. When you think of some of the other factors that are at play as well, earnings have started to come in a little bit better than expectations. Yes, expectations are very, very low, but they have been beating those expectations thus far. So that bodes well as we move into what is the busiest week of reporting season. As I said in the intro to the show, just over 40% of the S&P by market cap reporting this week, including Amazon, Apple, Google, and Microsoft all reporting as we move through the week. So if we get some decent numbers there, that could really give the bulls a little bit more control, particularly of the tech sector. And of course, the other thing is the price is still in this upward channel, and we've tested the downside of that channel this morning, and we've stayed in it. So I certainly like playing this from the long side. I think if we get any dips into around 4,100, that would be somewhere where I would be looking to buy into. I think 4,200 might be a bit of a ceiling for now. If I got into the position, then you'd maybe look to take a chunk off there. But I think at the moment, fundamentally, I'm happy and comfortable with a core long equities position. And the only spanner that I can see in the works maybe two of them is one, a real disappointment from those tech behemoths this week, which seems a little bit unlikely. And two is if we get a more hawkish than expected Fed, but actually a May Fed pause seems pretty set at the moment. So long the S&P, buy dips and get out around 4,200 is my idea this week. Ryan, what about dollar Chinese? What are we looking at there?
Yeah, well, we're talking about trading ranges today, and this is one I'm looking at potentially trading a break. I like this from the long side. We've had multiple knocks on the door up at this 691 area. Again, we've had a bit of sideways action, and quite strangely, this one's been really quiet of late. So I'm not holding my hat out for too much here, but if we get a break of the 691, I'm looking at buy stops maybe through 692 just to catch a move above. Of course, if you miss the break, again, look for a confirmation move back to the broken level. If it holds, you maybe get a second chance. And if we get a break here, then I can easily see it going up to 695, 6s, 97s perhaps. I wouldn't suggest we go anywhere further unless there's some big news behind it. But I'm going to play this with a buy stop, keep the stop fairly tight, 688, 687. Don't need to put too much on the table and see where it goes from there.
Good stuff. Remarkably, you've done that in less than a minute as well, so we don't have to listen to that annoying timer noise. In that case, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Play Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together so brilliantly, as he always does. All three of us will be back this time next week, by which point I fully expect Arsenal's league title hopes to be completely dead and buried, but hopefully the market won't be quite as dead and there'll be a little bit more volatility for us to get our teeth into. If you've enjoyed the show, please leave a like on the video, drop a comment. If there's anything in particular you'd like us to be covering on the show, then do let us know. We always want to hear what you are interested in seeing, and we will see you again next week. Thanks as always for watching, and goodbye for now.